Hey everybody, Greg Barron here, Professor of Real Estate. Thanks for joining us today, and we're going to continue our discussion today on inflation and money supply and real estate and why you as an investor need to understand the correlation between all three of them. Stay tuned. So in one of our previous videos, we talked about inflation. We talked about why the government is the only entity that really controls inflation by either constricting it or by increasing it by printing money or going into more debt. Today we're going to talk about the money supply, and I'm going to show you the correlation, how M2 actually influences inflation and how you as an investor can actually do some predictive analysis to help you further increase your wealth through real estate investment. But first, let's jump into some recent news by the Fed on what's going to happen with the Fed fund rate come the next meeting. So first, the bad news about inflation. Just yesterday, Barron's produced an article where Powell says inflation progress has stalled and rates will hold steady for longer. The more recent data show solid growth and continued strength in the labor market, but also a lack of further progress so far this year on returning to our 2% inflation goal. Now, you remember recently I talked about just where in the world did they get this 2% inflation, and we determined that it happened way back in New Zealand, and the finance minister of New Zealand determined that 2% was the number, and later on the Fed chairman decided that, you know what, the U.S. should have a 2% inflation rate target as well. So this couldn't be worse for the commercial real estate market. They've been holding their collective breath, hoping that by June there would be another 25 basis point reduction in the Fed fund rate, but it's just not going to happen. Nobody knows at this point in time how long we're going to have these headwinds of inflation. In spite of everything that the Fed does, keeping rates the way they are, unemployment is still around 3.8%, and our GDP growth is still strong. So it begs the question, just what is it that the Fed really wants? Well, number one, they want unemployment to go up. Number two, they want inflation to go down. Number three, they want M2, the money supply, which we'll review in just a second, to reduce. And number four, they want people to quit spending money. So as a whole, I think the Feds understand that M2 is still exceptionally high. So if you don't know what M1 and M2 are, it's very simple. M1 is basically savings and checking accounts. M2, you add savings, you add checking, you add CDs, and you add money markets. So basically, it's everything that would be deposited at a bank. And because the banks have the ability to see what these accounts are comprised of, they can tell you at any point in time just what's out there in liquidity. And here's an opinion that I hold. They do understand the liquidity out there. They know it's not like 2009 where we had illiquidity, and therefore they're okay with these rates staying high, even at the expense of the commercial real estate market, understanding that there's going to be trillions of refinance that need to happen or not happen, and they know that there's liquidity in the markets, and they're willing to make this bet. They're willing to allow some failures and even some bank failures because of the amount of liquidity that's currently showing in M1 and M2. So let's jump into Performa Plus right quick. We happen to have a resource button there which shows you the current levels of inflation. It shows you the current levels of M1 and M2, along with some other indexes that will be helpful to you as an investor. So you'll notice with Performa Plus, we have a resources tab, and I'm pulling up specific indicators for the money supply. And as we look at this, you'll see that the bottom blue line is M1 and the top black line is M2. M2 is always going to be greater, all things being equal historically, because M2 includes CDs and money market accounts. But look at how we have a gradual incline, which is normal because of population growth and usually because of savings. But as we hit here around May of 2020, you'll see that's about the time that all the stimulus checks were popped into the money system. Here we have a absolute vertical line on M1, and then we have a pretty quick acceleration of M2 as funds were transferred in from savings account to CDs and money markets. So the correlation of that, really, you don't want to park it on the number as much as you want to park on the acceleration of the number. Economists say, and it's proven up by historical graphs, if we go over here, you see a same correlation here about the same time that you see the money supply accelerate. You also see inflation accelerate. Now, the basic correlation there is more money into the system, more opportunity for spending, more demand for consumer goods, and less availability of consumer goods, which pushes prices higher. This correlation is always going to be in alignment with an increase in the money supply. So it stands to reason that any time you're going to print money and push it into the system, you're going to have more available funds, and the velocity of that is going to increase a propensity for inflation. Without question, the pandemic stimulus created the opportunity for inflation. You really can't have one or the other. Anytime you print money and push it into the system, you make more money available to the system in general. You make more opportunity for purchasing of goods. You create more demand for purchasing of goods, which means that the availability of them shrinks, which means the prices increase, which means inflation increases. So as I said before, there is a cure for inflation, except nobody wants to have it. It's just like alcoholism. The bad effects come first for the cure, followed by the good effects. To cure inflation, you're going to have to constrict the flow of money, which the feds are doing now by keeping their interest rates higher, to make the good effects come at a later date. The problem is everybody wants a cure, but they want it for everybody else and not them. So in essence, the government created the mess by printing the money. The government's going to have to get out of it. Only the government has the ability to cure inflation. So again, if we take a macro level and we go back, considering inflation, Fed fund rates, and the current money supply, what can we do to help us predict better to create value for us as real estate investors? So first, I want to talk to you about 3 things that you need to be aware of as you're positioning yourself in this real estate market. Number 1 is location. Rent-controlled municipalities will further hamstring good money from investing. So if you look at a recent article about rent stabilization, Brian Kavanaugh, who is a state senator for New York, and this is in the New York legislation right now being ping-ponged around as to the approval process, but it looks like this is going to be passed. But this headline says, Governor Hochul signs legislation to strengthen protections for rent-stabilized tenants throughout New York State. He goes on to say, Governor Kathy Hochul today signed legislation to strengthen protections for rent-stabilized tenants throughout New York State. Legislation S2 blah, 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 strengthens tenant protections by making various changes to avoid improper deregulations or rent increases and improve enforcement of the rent stabilization laws. This legislation will help to protect the 1 million New Yorkers living in rent-stabilized apartments and give our state better, stronger tools to enforce our rent stabilization laws, Governor Hochul said. As New York continues to face a costly housing crisis, my administration is committed to addressing the housing shortage, building new supply, and making our state more affordable. Number 2, wage rates. States with aggressive wage rates will drive out businesses, as we're seeing in Oregon and California and also in New York, reducing the opportunities for investment, which will make it harder for real estate development to meet their financial models. I'm going to show you some graphs in just a second to drive home this point about the individual wage rates compared to those states that also had rent stabilization. So my opinion is if you combine these two, aggressive wage rate hikes along with aggressive rent stabilization laws, you're going to further the opportunity to be destructive in value. You're going to dissuade real estate owners and developers to either acquire or develop in these municipalities. So the question you might ask is, Across the U.S., who has rent controls? So these following states currently have pretty aggressive rent controls: Oregon, California, New York, New Jersey, and the District of Columbia. So oddly enough, these same states have fairly aggressive wage rates as compared to the federally mandated $7.25 an hour. Now, I'm not advocating that $7.25 is the great figure. I'm not trying to make some statement that we don't deserve it. I'm just trying to show you the alignment and the correlation between rent stabilization and aggressive wage rates, which makes it all the more difficult for us as real estate investors to pick that particular location. Let's just face it, we want to go where our money is treated nicely. We want to go where the labor market is bountiful. So what's an interesting correlation is those states that have the most development and the most migration right now in population, and i.e. probably the most opportunity for real estate investment and development, are places like Texas, Arizona, North Carolina, and Florida. If you look, with the exception of Arizona, most of those wage rates are under $10. You also see a greater investment in real estate and a greater migration of people, which creates more opportunity. California is at $16 and $20 for fast foods. The District of Columbia is around $17 an hour, well above the $7.25. The rest of the states that I mentioned, Massachusetts, New York, New Jersey, all above $15 an hour. So the most important thing, if you don't pick up anything else from this video, is when you have an alignment of high wage rate growth and aggressive rent stabilization laws, you're seeing it create a death spiral for a lot of these municipalities because it comes destructive to real estate investment and development. Again, real estate investors and developers, by and large, want to go where their money is treated the nicest. So enough with all the bad news. What's the silver lining in this? Because there's always some good news if you're good predictors of what's going to happen. So here they are. Number one, the longer these rates stay higher, the more this dam continues to build up and the more product is going to be available in the future. Real estate owned assets from banks and also current landlords that aren't going to be able to kick the can down the road any further, and they're going to have to dispose or give the keys back. Number two, with rates staying this high, there's just going to be product that doesn't model out financially, which is going to create an increase in absorption of existing properties, and it's going to create a further demand down the road for opportunities for people to get in the game. We still have an undersupply of housing. We still have a demand for more single-family and multifamily housing. We're just not able to financially model it out right now with the rates the way they are. People aren't going to go anywhere. There's going to be especially in the multifamily and single-family asset classes, you're going to continue to see this demand increase, but the product's not going to be available because it's going to be previously absorbed. There will be opportunity, just not today. That demand is not going to go anywhere. And the last thing is there will be a scaled opportunity for a new generation of investors that have been sitting on the sidelines waiting to get in to create value for them that may be a once-in-a-lifetime opportunity. So be ready, keep your powder dry, and keep watching the channel. Thanks again for joining us today, and remember our motto: educate, evaluate, so you can ultimately execute to increase your own personal wealth. See you soon.